So, how you guys doing? So this is Leonard coming to you once again from Legendary Legacy Group. I appreciate you guys tuning in to the channel. We're going to talk today about, the five types of insurance. So yesterday I talked about term insurance, gave a little the characteristics about term insurance. Term lasts from 10 years, 20 years, 30 years. They usually, some companies have a 15-year in there. Some companies go past 30 years, but generally it's 10, 20, or 30 years, right? It is cost effective, the premium. So what are you paying every month for the policy is cost effective. It doesn't cost as much as, say, a permanent policy, right? Because you're only going to have it for 10, 20, or 30 years. The death benefit is pretty high. So for your cost effective premium, you're getting a really high death benefit, all right, or high face amount, which is what some people call it. Let me see. It is convertible. So before you get to the end of your term, so before you get to those 10 years or those 20 years or those 30 years, you can convert it into a permanent policy without showing, going to the doctor and submitting blood or anything like that. They don't take into account your health. Once you have the policy, you can convert it to a permanent policy without demonstrating that you're in excellent health or anything. The only thing that they take into account is your age at the time that you want to convert it. Okay. One of the drawbacks of a term policy is that if you don't convert it in time, the policy basically is going to lapse. So when you get to that 10-year mark, that 20-year mark, or that 30-year mark, if you don't agree with the insurance carrier to say, hey, I want to go beyond that term, the policy is going to lapse. Another thing about the policy lapsing, after you go past that 10, 20, or 30-year mark, once you say you have a 10-year term policy, once you get to the 11th year, if you're paying $100 a month, year 11, now you're going to be paying $200 a month, for example, or $300 a month. Year 12, you're going to be paying $400 a month. So during that term, your price stays the same, your premium stays the same. But once you get out of that term, if you still want that coverage, it's going to cost you a lot to keep that coverage. All right, so now what I'm going to talk about day two of the five types of insurance is return of premium. So return of premium is in the term family. All right, so it's a type of term insurance where you get something called a return of premium. All right, so return of premium, or they call it R.O.P. Some people. All right, some people call it also refund of premium. Okay, remember it's a type of term insurance. It usually, what I've seen, is that it's going to last you for 30 years. All right, so the policy is going to last for 30 years. I haven't seen any true R.O.P. policies that go beyond that or go, stop before that. The ones that I've seen, might be somebody out there that's seen something different, but the ones that I've seen have been around, last 30 years. The premium is a little bit more than a regular term policy. Why? Read it in the name, return of premium. So what does that mean? Because you're paying a little bit more than a straight term policy, after your term is up, those 30 years, you're going to receive all your premiums back. Now think about it. With car insurance, if you have a vehicle, right, and you've been riding around for so many years, and now it's time, okay, I'm done driving. You got to the age where you don't drive anymore. You don't want to drive anymore, right? You want to be chauffeured around, but you want somebody else to chauffeur you around. So you want to get rid of your car, get rid of that car insurance. So you go sell the car to somebody, give them the title, all that. But that car insurance that you've had for all these years, what happens with that? You get your money back for paying car insurance all those years and you never got into an accident? No, you do not. But with a return of premium policy, a R.O.P., return of premium or refund of premium. Remember, some people interchange those terms. Return of premium policy, after those 30 years, you get all your money back. So, for example, say a 45-year-old has a policy for 30 years. So now he's 75, right? So he's doing $100 a month, okay? So $100 a month, and remember I said it's either going to cost more than a term policy, a little bit more, or the death benefit, what the family is going to get if you pass away, is going to be a little bit less. So as compared to the term policy, the term example I gave yesterday, it was $100 a month, and the client had $500,000 in insurance. With this one, $100 a month only gets you $200,000 in insurance, okay? But after those 30 years, you're doing $100 a month times 12 months times 30 years. That's $36,000 that if you live to those, to the 30-year mark, you get everything that you paid into that policy, you get all that money back. You get a check for $36,000. So some people call it like it's a kind of qualified as like a savings account with some added benefits, right? So it's kind of equivalent to a savings account, because what happens if you put money in a savings account or put it under your bed? Just put $100 a month for 30 years. You're going to have $36,000, right? But with a R.O.P policy, if you pass away within those 30 years, your family gets that $200,000. Your family gets the money from that insurance policy to bury you, to pass it along in your family, to create generational wealth. Think about what $200,000 would do to a family, any side of town, in any state or city that you live in. $200,000 to a family, if it's managed the correct way, that can create generational wealth where you can build on that $200,000. So these are some of the things that I just want to show you guys. Me and my wife, you can contact us on our website or phone number 773-458-0020, or our website is legendarylegacygroup.com, or you can shoot us an email at llg@legendarylegacygroup.com. Listen, you guys, it's my honor, my privilege to share this information with you. Somebody shared it with me years ago, and I'm glad that they did, because there's so much that you can do with insurance. People always think it's about for when you're dying. Well, this isn't about for when you're dying. This is just to have some coverage in case something happens to you, so that you're protecting your family. But after those 30 years, you get your $36,000 back. That's not about when you're dying. That's still about when you're living. All right. So you guys have a blessed rest of your evening, and talk to you soon. All right.